We're obviously well awaiting central bank policy responses from around the world, getting the RBNZ just now, policy rhetoric from the RBA. Now, I just think we're in tune with a gentle but forceful forecasting of how we're going to adapt to a higher inflationary regime here, and more importantly, how central banks are going to continue to adapt to it, being more data dependent perhaps, being more pensive and elaborate a longer adoption process. But it doesn't necessarily always mean that you're going to get a higher rate hiking cycle, and it probably means that we have to not necessarily handicap the traditional reaction of weaker growth, which is accompanied by lower rates and a more stimulative process. So we have a balance of tasks here ahead of us over the next few quarters, which are going to be confounding, just as you just mentioned, with the RBA. So the task is at hand for investors and portfolio managers alike over the next few quarters.
Yeah, it seems that the pandemic has just messed with our ability to analyze cycles in many ways. So you have data that's soft. You have labor data in the U.S., for example, that's quite strong. What do you think the assumption? What are we assuming that's wrong?
Well, I think one of the practicalities is that we're getting back to an economy, perhaps, and maybe central bank policies, which are reflective of a non-stimulative era. We are getting back to a pre-global financial crisis monetary policy regime, one where, yes, we have had responses which cut off the left tails of risk, but may not be as elaborate, detailed, or likely as they once were just past the global financial crisis. Said more simply, when we get to the point where this atrophy of inflation doesn't necessarily happen as quickly as central bankers or even investors think, we may not necessarily have the accommodation at hand that might come along from central banks, whether it's the Fed or other places. So perhaps it's just a reversion back to the old regime of one where we have higher cost of capital, where we have to take into account more data-dependent Fed and other central bank policy reactions, which means ultimately the insulator, the reduction of volatility within marketplaces that we've become so accustomed to over the past decade or so is actually being removed, which creates opportunities but also uncertainties over the foreseeable future. So likely at Pimco, we're thinking that the marketplace is ripe for a more defensive posture over the foreseeable future, one that we might actually stay here. The potential is for us to stay here at these higher rates for longer and not necessarily embrace rate cuts as quickly as the market suspects over this point in time. And so that just simply means that the soft landing scenario is not one that we at Pimco really adapt to in the short term. We want to be more constructive, more defensive, focus on more liquidity in portfolios as such.
Jerome, you say that we may not necessarily see rate cuts. How about rate rises? We heard from Mary Daly saying, you know what, the risk of doing too little outweighs the risk of doing too much. I mean, it does seem like this is a Fed that's willing to tighten till something breaks.
Yeah, I think what you're seeing and observing is the debate within the Fed. It was pretty remarkable at the last Fed meeting, simply that we had a consensus vote. There was no outliers, there was no non-consensus attendees in that regard. And we might very well happen to have the same thing in July, even though we do get a rate increase. But what I think you're having is a healthy discussion of the destination. Perhaps we are getting closer to the end of that rate hiking cycle, recognizing the fact that the real question at hand is not how much to tighten, but at what extent do the lags actually take place with the tightening that has already occurred. And that's really the focal point of the Fed debate at this point in time, is that we might see disruptions, perhaps a little more volatility, that may elicit, as a data-dependent Fed gets more involved in this, more tightening process, or perhaps less of a cut, a likelihood of a cuts in 2024 as 2025, as the market suspects. And that really is the culprit at hand, or really is the thing to be reconciled between market expectations and ultimately the Fed's expectations of where they want and where they think that inflationary expectations are ultimately going to reside. Simply put, this PCE number tomorrow, this CPI number tomorrow rather, and today in the U.S. Is going to be very important, and really particularly focus on that core number that is moving from 5.3 to 5%. Let's be honest, while it's still showing the right direction, it's still well above the targets that the Fed wants to embrace at this point in time, which means that the likelihood of embracing growth or supporting growth is probably further out of the money than most people suspect at this point in time.